The market has been crazy lately. Of course, everyone knows that. The tech sector side of the market has been even crazier than the general market. It's down more than the general market is right now. And today, I wanted to talk about some ETFs that track the tech sector. Specifically, I'm talking about XLK, VGT, and also FTEC. We're also going to touch on Triple Q in this video, but basically, if you're not familiar with these ETFs, VGT is the Vanguard Information Technology Index Fund. XLK is the Technology Select Sector Spider Fund from State Street, and FTEC is the Fidelity MSCI Information Technology Index ETF. These ETFs, they're down quite a bit year to date right now, and you're probably doing one of two things. Maybe you own some of these ETFs, or maybe you're thinking about getting into these ETFs. And so one thing you might be thinking is that, okay, what's going on inside this ETF, these different ETFs during the past year? Well, if we look at FTEC, XLK here, we also have Triple Q on here and VGT. Well, XLK is down 29% for the year-to-date return. So this is since January. FTEC is down 30%. VGT is down 30%. Triple Q is down 31%. So these are all down quite a bit for the year, year to date. But if we take a look at the year, it's a little bit of a rosier picture. So we're only down 20% in XLK. FTEC is down 23.7%. VGT is down 23.86%. And then Triple Q is down 25.67%. So a little bit better when you go out to the 1 year, worse when you go out to the year to date. And so now we're kind of thinking, we're like, okay, is it time to be getting into these ETFs? Are they down enough so that these are cheap now? It's a good time to buy. And of course, a lot of people, they go and invest. And I'm one of these people who, if you look long term, if you look out past the time horizon of just a few months, then you'll see that a lot of times you're going to think that things that are down are actually probably cheap right now, and they might be a good price. So the question is that right now? Should we be buying these ETFs right now if we're interested in having exposure to the tech sector, or should we wait? Of course, this involves things like market timing and things like that. But what I do want to talk about is kind of a risk that there might be within these ETFs, and that is basically their concentration. So looking at a comparison of these ETFs, so we have VGT here with 375 holdings, and you're thinking, okay, that's a lot of holdings. It's a very diversified fund. XLK, okay, fine. 79 holdings, less diversified, but then you have FTEC with 387, and you might be thinking to yourself, okay, well, these ETFs, at least they're pretty diversified. You know, there's a lot of different holdings in here, but here's kind of where it gets a little bit convoluted, maybe a little bit surprising to you to see here. So if we go down to the top 10 holdings, we could see, look at the top 2 holdings and the percentage inside those top 2 holdings. We have Apple, 22.47% in VGT, Microsoft, 17.99% in VGT. All right, that's a lot of weighting just in 2 stocks. XLK, 24.29%, Microsoft 22.17%, FTEC 23.36%, Microsoft 17.49%. So I hope you're kind of seeing here that diversified in terms of their amount that's in each of those holdings, because these companies in the tech sector are so large. They take up such a large portion of the tech sector, and this is a market cap weighted index. All of these different ETFs are market cap weighted, meaning that the bigger the company, the more weighting inside the portfolio, and this is kind of what's happening. So the question is, what if these 2 big companies have some issues now? Because I think right now we can all agree, or maybe you're not sure about, or maybe you haven't seen this before, but Apple is not down as much as a lot of other companies that are inside the tech sector. Let's take a look at what's going on in Apple, so I'll show you. Now here we have Microsoft year to date. Now remember, VGT, XLK, FTEC, Triple Q, they were all down around 30% year to date, and Apple here is sitting at 17%. Apple has really been holding these ETFs at basically, because of Apple, there have been a much better return in these ETFs. Now, if Apple were to fall more in line with some of its peers, and we're looking at an even further price decline in these ETFs. Now, let's take a look at Microsoft here, and you can see Microsoft is more in line with the decline so far of the other ETFs decline. So we're looking at 28% decline for Microsoft. And if we look at Triple Q, you can see 31% for Triple Q. And so what we're doing here is we're saying, okay, under a circumstance where we do end up in a recessionary period, And Apple does not do so well because it's been kind of the only stock that's been standing. What if Apple really starts to fall more in line with, let's say, the general market? Then it's going to be a decent little jump down for all three of those ETFs. The other thing is that if Apple were to fall, let's say in the future, let's say over the next few months, Apple falls down more in line with triple Q, but let's say recessionary period and we have more negative information coming out and actually the index falls even further and Apple falls further with it and catches up, then we're talking about a lot of potential declines in these ETFs. And so basically when it comes to the risk of these ETFs, what I just wanted to tell you is that they're kind of concentrated in these two top stocks. And because of that, there's some risk to maybe just understand that you're taking. Now, on the bright side of this, if we take a look over here at the different valuations or the analysts' ratings of, first off, we have Microsoft here. We have buys on all of these for the 3 months, 1 month, and current here. So we have 36 different buys, overweights, and then no one has underweight or sell for Microsoft. And we could see a target price. The average is $326 per share. So if we go back and we take a look, Microsoft's selling for $237 a share. So $326 is what the analysts think it's worth right now. And it's actually a 35% increase if that were to occur. So maybe, we're thinking of things like if this did happen, well, then your VGT ETF, your XLK ETF, your FTEC ETF, it probably is going to definitely benefit it. But analysts may be cutting ratings soon depending on what happens economically in the macroeconomic environment. People are thinking they're going to start cutting their ratings on stocks, but so far, yet to happen too bad with Microsoft. And let's take a look at Apple. So for Apple, we have 27 different analysts with buy ratings over the past 3 months, 1 month, and current 26. Overweight 5, hold 10, 9, 7. Only a couple just one underweight for the past few months and only one sell. So mostly the analysts on Wall Street are pretty bullish on Apple. So we could see $182 per share is the target price, the average of these analyst estimates. So let's see what that looks like. So Apple's currently trading at 150. So if we take this and we say, okay, well, if it goes up to 182, what's that going to end up being? And it looks like it's about a 20% gain if that were to occur. So on the other side of this, maybe these stocks are actually undervalued according to the analysts at least, and maybe they're not going to fall too much further. And maybe when you're buying these ETF, these stocks like Apple and Microsoft are actually discounted and you're getting a good price. So maybe they're on sale for you. One other interesting thing you might want to know is that right now Apple is now the market's most shorted stock. So Tesla used to be, now Apple is. So does that mean anything? Maybe the hedge fund managers are wrong and Apple shouldn't be shorted like this, and maybe it should. I don't know the answer to it, but I just wanted to make this video to make sure everyone kind of knows that there is a lot of money that's in those top two holdings in all of these three ETFs. Last potential thing you could do, maybe just as an idea to think about, if for some reason you were really bearish and you didn't like Apple and you didn't like Microsoft right now, and you do think those stocks are going to fall further and you don't want to necessarily have the exposure in, let's say, VGT, XLK, FTEC, well, there's RYT, and RYT is an ETF that invests in the tech sector. However, the difference is it equally weights the portfolio. So instead of having a portfolio like VGT, which has the largest companies, they're the biggest weighted, so it's market cap weighted, well, RYT is actually equally weighted. And as you can see, all of the weightings of the stocks are going to be very low. And that's because it's equally weighted. So every single stock in this fund should have the same weighting, the same percentage of the fund. And that's why you're going to have a more equally weighted portfolio of different tech stocks. And so if you are scared of one or two stocks really hurting the returns in these ETFs, well, you could always think about that one maybe. At the end of the day, I don't have an opinion on whether I think something bad is going to happen in this. I just wanted to make a video to talk about it. So I think it's good to know. Just so you have the information, do with it what you must. That is all I have for this video. I hope you found it interesting, useful maybe. At the end of the day, I just thought it was an interesting topic, so I figured why not tell the viewers of this channel what's going on. So if you liked the video, please hit that like button and subscribe to see future videos like this, and I got another video coming up on the end screen right now. Thanks everyone so much for watching. I do want to remind you, I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence.